The foundational rule of the stock market is drilled into every investor from day one. You buy an asset at a low price and hold on to it with the sole expectation of selling it later for a profit. But that traditional strategy, known as going long, has a glaring limitation. If you know a company is failing and its stock is about to drop, buying and holding does absolutely nothing for you. To capitalize on a falling market, traders use an inverse strategy called short selling. This is, strictly speaking, placing a financial bet against a specific stock. Let's look at a trader named Jack. Jack has just uncovered some troubling information. Goliath National Bank is in severe financial distress, and he expects their stock price to crash very soon. To move from prediction to profit, Jack has to navigate a seemingly impossible mechanical trick, selling an asset he doesn't legally own so he can profit when the price inevitably drops. Jack initiates the trade by contacting his broker. He gives a very specific order. He wants to short exactly one share of Goliath National Bank. The broker borrows a share from another client's portfolio and instantly sells it on the open market for $100. That cash is then credited to Jack's account, even though Jack never actually purchased the underlying asset. Jack has successfully monetized his negative prediction up front, but he is now mathematically indebted. He owes the broker exactly one physical share of Goliath National Bank. Fast forward 1 week. Goliath National Bank's financial crisis is made public, and just as Jack predicted, the stock price plummets from $100 down to $70. To finalize the trade, Jack needs to perform a mechanism known as covering. He has to go back to the open market, buy a single share, and settle his outstanding debt to the broker. Because the price dropped, Jack uses $70 from his account to purchase the discounted share. The broker takes that repurchased share and returns it to the original client's portfolio, completely closing the loop. Jack gets to pocket the remaining $30 as pure profit, minus a small mandatory borrowing fee charged by the broker for facilitating the loan in the first place. By operating in reverse, the short-selling mechanism actively rewards traders who accurately predict failure. They simply pocket the spread between the high price of the initial borrowed sale and the lower cost of the repurchase. While Jack walked away with a quick profit, short selling is strictly restricted to advanced traders for a terrifying mathematical reason. This graph models the risk matrix of a traditional long investment, starting at $100. If the company goes bankrupt, your maximum loss is capped at that initial investment. Meanwhile, your potential profit scales upward indefinitely as the stock grows. Now, consider an alternate timeline. What if Jack's hypothesis was entirely wrong, and Goliath National Bank's stock price rapidly started to rise instead of fall? This chart models the inverted risk of going short. Because Jack started by selling at $100, his absolute maximum profit hits a hard ceiling at exactly $100, even if the stock drops completely to zero. But if the stock rises, Jack faces a catastrophic reality. He is legally obligated to buy that stock back to return it to his broker, which means he has to pay whatever the current inflated market price dictates. And here is the core mathematical terror of the trade. Because a stock's price has no theoretical ceiling, the out-of-pocket cost required to repurchase the share has absolutely no limit. When you buy a stock traditionally, you can only lose the capital you put in, but short selling uniquely exposes the trader to limitless, life-altering financial ruin if the market turns against them. Short selling remains a highly effective tool for generating capital during broad market downturns, but those structural risks demand extreme defensive measures. Executing this strategy safely requires a singular fail-safe built into the trade itself, the implementation of a stop order. A stop order functions as an automated trigger. If the stock price unexpectedly rises to a predetermined maximum pain threshold, the system forcibly buys back the stock and closes your position. Profitable short selling depends on having the absolute mechanical discipline to ensure a single incorrect hypothesis doesn't wipe out your entire portfolio.